And traders, economic factors that affect the economy, that affect price movement in the market. We are looking at those factors. Federal fund rate is one of these factors. What is the federal fund rate? So, the federal fund rate is the target interest rate set by the Federal Reserve, the Fed, at which commercial banks borrow and lend their extra reserve to one another overnight. We call it interest rate. It is the borrowing cost of money. So when the Fed set that interest rate, commercial bank let other banks borrow the reserve at a rate. Okay, that's the price. That's the cost for borrowing money. With that, what's going to happen? The commercial bank let the other banks, which is your personal bank, your local bank, your regional bank, they borrow that extra money from those commercial bank at a rate. So in the local bank, when you go to get a loan, your local bank set the interest rate, how much they're gonna charge you. So if you want to buy a car, if you want to get a loan, if you want to get a personal loan, those federal fund rate, the higher they are, the more you, the customer, will pay more for that money. This is why the federal fund rate, which is the interest rate set by the Federal Reserve, is so important. Every month, the Federal Reserve either keep it the same way or move it up and down. So if you know the Fed is about to set interest rate, you need to know that, because as an investor or trader, stock price will go up or down, index will go up and down, currency price will go up and down, because when the Fed move the interest rate, increase it, the value of the US dollar will increase. When the Fed bring it down, the value of the US dollar will decrease. So if you are a currency trader, you need to know about the federal fund rate. So the interest rate at which depositor institution lend balance is held at the Federal Reserve to other depository institution overnight. You need to know that. That's overnight. We already said that. This is important. Why is that important? Short-term interest rate are the paramount factor in currency valuation. If you are a forex trader, if you are any trader, if you are an investor, you need to know the short-term interest rate that's the Federal Reserve set is increase and decrease the value of the US dollar. That's when the Fed, with the power to print money, can decrease the value of your dollar in your pocket. So when they print money, when they increase the interest rate, your dollar gain value. That's when you can buy more with the dollar. But when they print money, that's when the value of the dollar decrease. That's when your dollar will worth less. You can buy less stuff with your dollar. Traders looking at other indicators merely to predict how rate will change in the future. If you a trader, what do you pay attention to the indicators, what's going on, and not only the other indicators we already talked about, but the interest rate. You have to try to predict, is the Fed is going to increase interest rate or decrease interest rate. Right now, there is an inflation going on. Price is high. Interest rate is continue to increase. The Fed continue to increase interest rate. If you are in a trade, that's mean the price can move 300-400 points in like seconds. So you need to be able to know that's what's going on. Something is going on. Why the price is moving that fast? Because other traders are they trying to think about, to look in ahead what's going to happen, and then if they need to sell their stock. If the Fed is going to decrease stock value, the price of the dollar, and then you have a stock, most likely the price of your stock will go down. If you know that before it goes down, you sell it, and then you wait for the Fed to speak to decrease interest rate. When the price of your stock goes down again, what happened? You buy it low again, and then in a couple months, and next month, next week, when it's continue to grow, you can make money. The same thing if you are a trader, you can wait for the Fed to speak. He can send the market way up 500 point. Most likely, when it hit his peak, he will go down again. So now what you do? You wait until the Fed move the market, and then you buy it on top, and then you wait until it goes down, and then you take profit. You can wait until if they bringing it down, you wait until the price goes do all those crazy things. When it hit its bottom, you buy it there, and most likely you will increase a little bit. Then you can take profit. But that's a risk you are willing to take as an investor. If you're not willing to take the risk, you wait until the storm pass, then you come in the market when your technical analysis can be a little bit more accurate. So this is what we want to know. You want to know. We want to know the federal fund rate we call interest rate is the cost for borrowing money controlled by the Fed.